35 years ago, a Harvard business professor made a prediction about Wall Street. This was 1989. The leveraged buyout craze was in full swing. That's when a group of investors takes a public corporation private using loads of debt, then typically dismantles it and resells it in hopes of huge profits. One of the most famous buyouts was that of RJR Nabisco, a conglomerate that produced both Oreos and Camel cigarettes. The details of the competing takeover bids and the eye-popping sums of money were so lurid that it later made a best-selling book, then a movie.
All we want you to do is make us as rich as possible.
The old guard of the financial industry was aghast. Leveraged buyouts were leading to layoffs. They were chopping up storied corporations, and they were revealing Wall Street's most ravenous animal spirits. But where many saw greed, a professor named Michael Jensen saw the future. His article, The Eclipse of the Public Corporation, predicted just that. For Jensen, it was companies that had become the problem. They were getting bigger, but not better. Public companies are owned by shareholders who want value, but they're run by managers who may have different motives. Say, the prestige of running a larger company versus one that's more focused and efficient. This tension was a problem for Jensen, and it's why in 1989, he concluded that private firms, where owner and manager were the same, would fare better.
It was a very prescient article.
It's such an iconic reference point in the literature. Everybody knows it.
But was it right? Was the public corporation, a centuries-old concept that relies on the public to raise money, really about to be overshadowed? The number of companies listing on stock exchanges actually rose in the years after Jensen published his essay. And then, in the mid-1990s, that number began to fall. And it hasn't recovered since. From more than 8,000 publicly listed firms in 1996, the US had less than 4,000 in 2019. The same trend hit other developed economies in the years to come, from Germany to the UK and France. Meanwhile, private investor deals, known today as private equity, have skyrocketed during the past years, putting more companies in the hands of exclusive investors. So is Jensen ultimately right then? Is the public corporation essentially on the way out? And if so, what does that mean for investors and economies? And what does it mean about the public role in raising capital? What happened to the public corporation? The first corporations go back centuries. They included grain mills and shipping expeditions. Today we have Apple or Microsoft, but the fundamental idea is the same, turning to the public to raise money and not to family. Corporations do that in public markets, what we often call stock markets. It might help to think of a public market as an actual market, like this one in Berlin. Businesses come here to sell things to strangers, like produce, flowers, and food. This market is open to everyone. Everything here is quite visible. It's been around for quite a while, and I know it from reputation. Modern stock markets share something in common with this market. They're organized, they're open. The prices are visible, they can be compared. That helps buyers suss out value and understand what's a good deal. Instead of selling goods, businesses use stock markets to sell shares in themselves, thereby raising money to grow, or capital. Those shares, in turn, can be easily traded, and that reduces risk to investors. But companies must convince the public that they're worth the investment. They follow strict rules and open their books. The free flow of information is critical to keeping prices accurate and reducing risk.
You want investors to have confidence in the markets in which they invest, because these are long-term decisions.
Andrew Caroli is Dean of Cornell University's S.C. Johnson School of Business in the U.S.
Trust and confidence in markets is absolutely vital for a well-functioning capital market and a well-functioning economy. I believe that in my core.
Some of business's biggest success stories have occurred in public markets. Amazon went public, or IPO'd, at $18 a share in 1997. It's worth almost 10 times that much at the time of this report. Microsoft stock has hovered around 20 times the price at which it listed in the 1980s. That growth was accessible to investors in the general public, whether they had bought the stock itself or had invested in a fund that had the stock. It's growth that also fuels major social enterprises. In the US and other countries, retirement funds and insurance pools traditionally invest in various assets, including stocks. More workers have also received shares, or stock options,
as a form of compensation. And that popularity isn't unique to the US, UK, or Germany. Stock markets have risen across developing regions in recent decades, China, for example. So why are the wealthiest countries moving away from it, while private equity is growing?
It may help here to understand what we mean by private equity and how it differs from public capital.
As its name suggests, private equity draws upon an exclusive set of investors. For buyouts, they give money to a fund manager who identifies a target company. The fund acquires the company in full and then calls the shots. Fund and manager work together to reshape the firm to the fund's liking. It's often years later when the fund exits the company for a profit, either by selling it or taking it public. Fans of private equity buyouts like Jensen argue that such deals create more efficient, focused companies, again, aligning ownership with management. And those firms do more than just leverage buyouts. They can take a public company private, restructure it and return it back to the stock market, or buy multiple firms.
Private equity then became really big, not just because of so-called financial engineering, because strategic acquisitions.
Robert Litton is an attorney and an economist at the Brookings Institute.
Putting companies together or mixing and matching, scrambling the eggs, because different companies had different pieces they needed alignment with.
Unlike in public markets, private equity isn't transparent. Fund managers call the shots, and private companies don't have to make disclosures. Valuing an investment is also difficult as there's no common marketplace. That makes sizing up risk difficult for investors, but it can also make the deals more lucrative than in public markets.
We came to the conclusion that there is in the US an unusually vibrant private equity market.
Caroli and two fellow researchers authored a study taking a look at the fall in US public listings in 2016.
Yes, it's everywhere in the world. Of course it is. It is truly a global phenomenon, private equity. But the vibrancy of the private equity market seems to be unusually robust in the US, such that it has precipitated this decline.
But Caroli says private equity is far from the full story. After all, what suddenly made private money a better option for companies than public capital?
To us, it's more about the change in the opportunity set to what it means to be a public corporation in the US, in Europe, in Asia. That is really what the headline is, I think.
In other words, what made it less attractive for businesses to raise their money in public markets and more attractive to go private?
That's where other researchers come in, like Ali Sanati from the Kogod School of Business in Washington, D.C. In a study from 2023, he looked at the listings gap in the U.S., that is, the number of companies that, given the country's past growth, should have been on public markets.
The big question is, okay, why this is happening, right? So there has been some ideas out there, and basically what we did in our study was we wanted to formalize and kind of compare these ideas, put them next to each other, do a so-called horse race between these competing hypotheses.
One possibility Sanati looked at is overregulation. In fact, in a letter to shareholders this year, JP Morgan CEO Jamie Dimon pointed to costly regulations as one reason why he believed public markets were shrinking.
Remember, regulation is part of what makes public markets reliable and transparent. It actually helps lower the cost of capital. But when is it too much?
Disclosure rules for public companies in the U.S. tightened in 2002. The Sarbanes-Oxley Act was a response to several high-profile corporate scandals in the U.S. at the time, all involving falsified accounting. The law requires that executives personally certify financial statements, and it increased the number of disclosures. Some worried that those measures would discourage companies by putting a higher price on risk-taking. Nobel Prize-winning economist Milton Friedman famously called the law an innovation killer.
However, Sarbanes-Oxley came into effect years after public listings in the U.S. peaked. That means that it couldn't have actually started that downward trend.
Researchers have still sought to understand the role of regulation on public listings. One paper from 2018 speculates that forced disclosures were more harmful to some firms than others. For example, disclosing a new factory, the study asserted, is different than an intensive research program, which could give away valuable ideas.
Regulation that happened in the stock market seems to be discouraging the small firms to get listed on the market.
So regulation plays a role in the lack of listings, but it still isn't the pivotal one. The researchers I've spoken to believe that role is played by another trend that's been dominant in recent decades: company mergers and acquisitions.
Government slashed interest rates in the mid-2000s. That makes borrowing easier, and it tends to encourage mergers and acquisitions. Tech companies have been especially active. Companies like Amazon, Google, and Microsoft have acquired scores of companies in recent years. When a public company acquires another public company, one of them typically delists, like when Microsoft acquired game maker Activision Blizzard. As these already public companies were growing larger, fewer companies were choosing to list in the first place, and some see a connection there.
A lot of tech startups are making products that either improve, some existing tech companies' architecture or its innovation.
Litton argues a kind of ecosystem was working itself out: large public companies and smaller niche firms.
And companies that are niche, they're incapable of becoming a rival to an AWS or a Google or an Oracle or whatever, because they're just making a small little piece of a much bigger mosaic, and the elephant wants that little piece, but the little company can't grow up to be an elephant.
In other words, the growth of listed companies, especially in tech, created a signal for smaller and younger companies to go for acquisition instead of IPO, and private equity gave them a ready source of capital.
So the only way the little company is going to get financing is it goes to a VC and says, look, if I'm really successful, I've got 3 or 4 potential companies going to buy me out. And so the VC finances the company knowing that there are buyouts at the end of the game rather than an IPO.
Caroli likes this explanation as well.
This is our thinking. We have no formal proof of this, and there's good reasons for the difficulty of pinning something like that down, is because there's just not very much archival data through which you can study which firms would have, could have, maybe should have considered an IPO.
Acquisitions of private firms, the so-called would-be public firms within the mergers and acquisitions, that's the main driving factor.
So now we have a better picture of what appears to be going on. Younger companies are more frequently turning to private equity instead of public markets, and they're seeking to be acquired instead of going public. The question is, what does this mean in the big picture?
Is it okay that public markets are now dominated by fewer but larger companies? Is it okay that there are fewer new companies seeking an IPO?
It's not problematic to me as long as we get the innovation. The most important is it there? Is there money available to people with new ideas to finance them? And to me, it doesn't matter whether it's private or public, as long as it's there.
Litton argues that some of those private equity-owned companies will later go public, even if the early growth is under private equity. Others are less sanguine.
It's the parasite that's going to kill the host.
Roger L. Martin is former dean of the Rotman School of Management at the University of Toronto.
A parasite, private equity, desperately needs the host for exits. And if they didn't have exits, they wouldn't be such a popular asset class. And what they need is a deep, rich, and stupid public market.
For many, private equity is less the brave disruptor of corporate largesse and more the problem itself. Their efficiencies strike many as cold-hearted, their focus on near-term profit harmful to long-term goals, so the thinking goes.
But what about for investors? Are they missing out if so much of a company's first growth, that explosive growth, is happening in private equity?
Public markets have changed. On the one hand, market valuations have been at near record highs.
I think the companies that are public today, as someone like myself has covered tech for almost 25 years.
Dan Ives is an analyst at Wedbush Securities in the U.S.
It's a much higher quality than maybe it was 15, 20 years ago, when you had a lot of froth, some garbage out there. I think the nature of public companies today, it makes a higher threshold for what's actually traded today in public markets.
On the other hand, there are fewer real growth stocks. It's less likely that an Amazon would hit public markets today at just $12 a share.
I think if you go back years ago, an Amazon, a Facebook, a Google, it's possible maybe they would have stayed private longer if they had access to private capital.
In one sign of how much has changed, Norway's sovereign wealth fund has repeatedly sought to invest its $1.7 trillion pension fund into non-listed companies like private equity. It argued to Norway's finance ministry last November that there were fewer listings and that companies were arriving later to the market, meaning the pension fund was missing out on growth. Martin sees another problem. A focus on short-term stock movements has alienated shareholders interested in long-term growth, like pension funds and employees. In 2021, he wrote an article for the Harvard Business Review calling for the creation of a long-term enterprise in which those two classes hold the vast majority of shares in a company.
The big owners of the capital of the company will be long-term investors like pension funds and the knowledge capital necessary to make for a great company. And if you had 20% other public shareholders who are just saying, hey, I like what you guys are doing, and therefore it's publicly traded, kind of no problem.
And then there's the $10,000 question. What does it mean for societies if public markets lose their leading role?
What is the best thing to foster economic growth? Is it sufficient to have a vibrant private equity market that supplants what would have been an even more vibrant public equity market to foster long-term economic growth? I can't answer that question. I'd love to be able to answer that question, but I can't answer that question.
One thing is clear. Capital markets have been around forever, but are still changing, leaving us to figure out exactly how.
And that's all for this episode of Business Beyond. Be sure to check out our other videos in the playlist. If, for example, you enjoyed this look at the corporate world, be sure to check out my colleague Marie's recent video on the shadowy world of management consultants. Thanks for watching.